Hello and welcome to the 2025 Outlook and Capital Market Review. We are going to go through a bunch of different slides, but I want to thank everyone for taking the time out of their day to join us or watch the replay. And this is for everyone that couldn't make our live event, as well as those of you that are around the country. So we love sharing what we've learned from this last year, and we look forward to the next year. So before I jump into the data, quick update on the family. Love to share that the next generation is doing great. Ben, here's a picture of him and Jenny down at TCU, the cowboy hat and the jeans. They wear this to the football games, even if it's 100 degrees. It's a good time. Got to take a trip to New York with Abby over one of her breaks and see the New York Stock Exchange. And we had a great time over here. Ben and Abby, he came home to watch her dance. She's a pom and in high school, and they just have a great friendship. And the family picture, we were at the Broadmoor, the beautiful Broadmoor, a fun family reunion on the Klatt side of the family. So with that, I will jump into it. So everybody's doing good. All right, the topics for today, we have similar to last year, the economy, of course, monetary policy, big deal right now, and fixed income, otherwise known as bonds, equities, also known as stocks, volatility, always good to talk about, and asset allocation, over some investing principles. So we want to keep it simple, try to bring it to a level where we can all understand it and make it easy. Thanks for all the feedback, and we'll continue to try to simplify some of these things. Okay, so jumping into it, starting with the economy. The end is near, the recession is near, guy, is sort of out of a job. The last 2 years, we shared how almost every economist said we were going to have a recession, and we actually didn't. So when you look at GDP, start off with our GDP chart like we do every year. We've got the year along the bottom. The bars are real GDP quarter over quarter annualized. And then you watch the line, and that's our year over year number. Over here is the financial crisis, 2008. Good marker there. The deep and long recession that we made it through. There were multiple quarters of negative GDP. Obviously, a lot of production was lost during that time. We recovered. And then over here, 2020, there's the COVID recession, even more severe, but very short, and the subsequent recovery. Now, I want to zoom in right here. This is 2022, and I had shared with you that there was 2 negative quarters of GDP. That has been revised, and one of them is positive. So we actually only have 1 negative quarter of GDP, so not the textbook definition of a recession. And the other definition, where the National Bureau of Economic Research, NBER, calls a recession based on the job market and sales and manufacturing and everything else, they never called it a recession anyway. So so we made it through that. It was definitely painful for stocks and whatnot, but everyone thought in 2023 and last year we'd have a recession. This is the soft landing. We did not dip negative, and we'll talk about what we think moving forward, but right in this 2 to 3% range for GDP, as you can see. Okay, what's our forecast? For last year, it was 2024, it was 2.7%. We just got the revised actual number, and we're looking at 2.8% is what we came in at last year. Our chief economist thinks 2.4% for 2025, 2.4%. So that includes kind of a baseline look at some tariffs going into place. But all in all, very similar, that 2 to 3% GDP for 2025. So not much different. You can see quarter by quarter how a little bit of a slowdown, and then we begin to accelerate again. So Why are we sanguine? Why are we optimistic and excited about this year, similar to last year? Here's 5 reasons and the five big drivers. So first one, we got to put first, 70% of GDP is the consumer. So of course, 70% the U.S. consumer makes up of the economy, and the consumer is strong. So we will show you a chart on that in a minute. Number 2, this is the reindustrialization fiscal policy. Yes, we have a lot of stimulus money that was actually never spent from a couple years ago. So even if a fraction of that came into the system, that would be highly stimulative. Number 3, AI investment, capital expenditures from mega cap tech companies up over $200 billion, billion with a B, over the last 12 months. That's a lot of spending, very stimulative. We think largely it continues. And number 4, deregulation, a new administration coming in. Typically, you have less regulation with a Republican administration, and that's what we're seeing, an emphasis there, and that is really supportive of markets and economic growth. Number 5, the Fed continuing on their path of easing, and we're going to talk about interest rates and what we expect, but at this point, the Fed has been cutting and pausing, and we'll see where we go from here, but it's the path of easing as opposed to tightening. Okay, so consumer finances. Take a look at the balance sheet of the consumer, and you can see the assets versus liabilities on the left. $190 trillion in assets we have in our country, and about a quarter, 28% of that is our homes. As you would expect, on the liability side, only 21 trillion with a T in liabilities. So a really nice looking balance sheet, and about 2/3 of that is mortgages. Most important piece of this is the household debt service ratio. So how leveraged are we? And I like to start at the fourth quarter of 2007. We were highly leveraged, and people were putting all kinds of things on credit and buying lots of houses and not putting money down, all those kinds of things. So we got up to about 16%, 15.8%. This is the debt payments as a percentage of disposable personal income, debt payments. So that came down, obviously, after the financial crisis. Took a major dip during COVID. Think back to, we were giving you money to stay at home, and you couldn't buy anything because everything was sold out. What did we do? We paid off our debts. So this ratio became very, very historically low. We've come back up and normalized, but really we're pretty close. 11, 12% is a good 30, 40, 50-year average. So consumer is in good shape. Confidence, and we like to look at confidence. As you know, that will impact retail sales, which is a big deal. Remember, consumption is 70% of GDP. So let's go through a few of these. Number 1, small business confidence, and you can see the largest monthly increase since 1980. Big sign of confidence there. Number 2, CEO confidence, and that's ticked up here. That's a good sign. Number 3, we always talk about consumer confidence. We talk about the University of Michigan survey, and that has ticked up again. So that's a good sign. And then the last one's investor confidence, and this one's interesting. It's ticked up and really is shot up even more recently. Any of these, including the last one, once they start to go really, really high, I get a little bit nervous. It can actually be a contrarian indicator, meaning the opposite is true. Maybe we're at the end of a bull market, but they're not all there yet. Just the one on the end. But that's something we'll be watching. But overall, confidence has an impact on sales, and we see that played out here with a couple charts next to each other. Here's the financial crisis. It's always a good one to show. And during that recession, our confidence just absolutely plummeted. We were all, there was blood in the streets. It was very scary. And what happened to retail sales during that time? Of course, they went down. And rather than growing at, 3, 4, 5% a year like historically we do, it was actually a negative number. So thankfully, we made it through that. COVID has disrupted literally every chart I'm going to show you. So there's a kind of a whipsaw here, low and then high, but it normalizes out. And that is why we care about confidence, because we will see we'll open our wallet or not, depending on how confident we are in the economy. So we're at a good place. Okay, employment. Let's talk about employment. This dark gray line, almost black, shows the unemployment rate. And 50-year average is this line right here, 6.2%. And you can see after the financial crisis, October 2009, we were at 10%. We got all the way up to 10.1%. November 1982, we were also over 10%, 10.8%. This crazy COVID recession, 14, almost 15%. So that's hopefully never to happen again. But this is a lagging indicator. So you see this kind of spike after things have gotten bad. But where are we now? 4.2. We just got a number the other day. I think it's 4 even. We've been high 9s, low 4s, and a very, very healthy unemployment rate. So nothing to worry about there. Okay, labor demand. And this is the JOLTS numbers, starting with this chart in the top right. I just want to highlight the quits. And this gets talked about. You have to be very confident about another job you're going to. You're going to get a big bonus. You're excited to quit your current job. That's something they also track. And you can see how that peaked October 2024, and that has come down at a nice pace. A lot less people are quitting than they once were. And that's also gone, if you look on the chart to the left, gone along with this chart. The total job openings, we were up to literally 12 million job openings. These are jobs that are posted, they're open, and theoretically, we're trying to get those filled. That has come way down. We're closer to 8 million job openings, 7 at this time, and that's kind of makes more sense. That's a number that's on par with a long-term trend. Okay, switching over to monetary policy, number 2 on our topics for the day. We've got Fed Chair Jerome Powell sweating it out. These memes are so funny. Which button do we push? 25 basis point cut, 50 basis point cut. What's it going to cause? Actually, he's not really sweating. He's been doing a pretty decent job. But let's take a look. The federal funds rate and expectations. So let's start off with this part of the line right here, where we came out of COVID. During COVID, they dropped the federal funds rate to 0, and remember, effectively 0, what they call, and all the other rates follow. So remember, when rates were low, that was very positive. If you were getting a loan, if you were buying a house and getting a mortgage, you got a very good rate. It was very bad if you had a lot of cash and there was no interest. It was very bad for bonds. There was no interest. Inflation got crazy, which we're going to talk about, and they began to hike. And look at how steep this was. This is the most aggressive campaign ever to fight off inflation. We basically went straight up in a very short amount of time, which honestly tells me they probably started too late. They said it's not a problem, it's not a problem, and eventually it was a problem. So this is a nice line here, how we came up, but this is just so steep. Eventually, inflation peaked and was coming down. They paused, and then you may remember last year we began with the cuts. We had a 50 basis point cut, 2 25 basis point cuts, and as of yesterday, we just had some news and a press conference, and they said they are going to pause. So when you take a look at their dot plot, that is what they project for moving into the next few years and where we'll end up in the long run. And this is where they have kind of their neutral rate, 3%. Well, The green dots, that is what the market expects. And the market's not really buying it. The market thinks we are going to be a little bit higher for our new neutral. Our chief economist here with the firm believes that we have 2 more rate cuts coming in 2025. That's 2 25 basis points cuts. That's not a lot different from here. That doesn't change interest rates a ton. But that is a huge change from a year ago when everybody thought it was 4, 5, 6, 7 cuts once we got to 2025. So that is not the case. Why has the Fed paused? Why are they dialing back the expectations? Why are we not cutting? Well, inflation, I hate to be the bearer of bad news. Don't shoot the messenger, but inflation has ticked back up. So inflation is September, October, November, December, and January, we just got the number, has gone back up. 2.4, 2.6, 2.7, 2.9, and 3.0 as of yesterday, I believe, the CPI, headline CPI. So we're going to talk about inflation, but when inflation is going up, you're not cutting. Remember, inflation was going up and they were raising rates. So worst case scenario, we get a raise this year, but I'm here to tell you we may just get a long, long pause, and I would be just fine with that. So we'll see. Okay, inflation. Let's dig into it a little bit. Hope everybody's having fun with this. But we've got 4 lines. We've got 2 on the left with the PCE numbers, and we've got 2 on the right with the CPI numbers. So the top line is the headline, what they call headline, CPI and PCE, and the other line is what's called core. And core excludes, you strip out food and energy. So it's a little more concentrated. It's supposed to be not as volatile, so it doesn't go up as high per se, or down as low per se. What you see in the news is always headline CPI. That's over here. We hit 9%, 9.1%, if you remember, and that was not good. Fed raised rates. We fought it off. We came back down. We're in a much better spot. The Fed is actually not watching CPI as much as PCE. That's their preferred measure. And this one's a little more nuanced, the way they calculate it. And more specifically, they like the PCE core. So we will be watching that. We'll be watching all 4, but we're really watching the PCE. Okay, the harmonious relationship between inflation and job growth. Now we're really having fun. Okay, we got some bubbles for you, bubble bath. You look at the blue bubbles, these are expansions in the economy. You look at the red bubbles, these are recessions. And what you notice is the blue bubbles are concentrated on the right and not too low. And that's because, well, what the lines on this graph represent. Well, along the bottom, you've got payroll. So when jobs are created, non-farm payrolls, this is a 3 months average in thousands. So 100,000 to 200,000 is kind of a sweet spot. There's a lot of expansions that happen historically when we're creating 100,000 jobs. And obviously it goes negative when you go to the left. That's why you have recessions over here. We're losing jobs. The other part of this is inflation. And when core PCE year-over-year change is around 2%, there's a whole lot of good happening, a lot of expansions, not a lot of recessions. So this is the sweet spot. If there was 4 quadrants, this is the sweet spot. Where have we been the last 3, 4, 5, 6 quarters? Right in this spot, right in here. So it has been a very good market to not have a recession, and hence we literally haven't had a recession. Now that's not to say you can't have an expansion if you're outside of these boundaries, up here, up here, up here. Doesn't mean you can't have a recession technically, as you see some of these, but largely we want to be right in this area. That is proven out by a couple stats. Number one, 70% of recessions happen when inflation is above 2%. So that was that line I was just showing you there. And 87% of the time, employment growth is below 100,000. So that's why we talk about these quadrants. Okay, let's switch to bonds. James Bond. That's a joke. Fixed income. Fixed income is bonds. Okay. I wanted to show you this because we look back at fixed income, how bonds have done really since the beginning of the ag index. And this goes back to 1976. What we went through, we're a couple years out now, but what we went through in 2022 was just awful. And I want to highlight it because it was so hard for bonds, and we made it. We survived. Everything's fine. It was not fun, but that is hopefully just a once-in-a-lifetime event, sort of like how we felt coming out of the financial crisis for stocks. It was so bad, and I'll put that up in a minute. But when you think about bonds, the worst year, in my career, obviously had been down 2%. The lowest year for decades was down 2%. And we were down 13% plus in 2022. And remember, with a bond, you don't lose anything unless you sell, of course, but unbelievable drawdown. Specifically on this chart, the red dots are how low we went at some point during the year, and then the bar is where we finished the year. So just wanted to kind of highlight, it was rough. It was rough. 1931, I read, was the last time historically that stocks and bonds went down so much in the same year as 2022. So we made it, and some perspective, bonds are positive 44 out of 49 years, great odds, and an average intra-year decline or drop of 3.5%. So not a lot of volatility in bonds, fixed income compared to stocks. Okay, this is fun because we look at the starting yield and look at the 2010s when you're starting at 2% with an average starting yield. What's our growth expectation? Not much. But where are we now? Oh my goodness, starting around 5% with an expectant starting yield, and our subsequent 5-year return so much better. So we are in a new era, and this shows decades how it's moved over the years. But when bonds we're getting 4, 5, 6, 7% on a bond, that totally changes the expected return. So I don't think we're going to see 2022 happen anytime in the near future. All right, stocks. Let's talk about equities. Thought this was kind of cute. Stocks fell sharply today on predictions of speculation, of rumors, of negative indicators, and then you get scared, and then you call me, and then I tell you everything is going to be fine. No, you guys are good. You don't call and stress and freak out, but there's always something going on with stocks, and the news is here to scare you. I'm here to give you perspective. Okay, 2024, let's get into it. The very last column here, periodic table of investing, shows U.S. equities were up 22% last year. A blended portfolio was up half of that, 11%. Cash 5%, 5% non-U.S. equities, 4% real estate, 1% bonds, and 0.1% for commodities. So why in the world did I make 11% when the S&P 500 was up, 22% plus? Well, let's talk about it, because that's very unusual. Usually the disparity is not that much. Well, it has to do with the Magnificent Seven. So of course, the Magnificent Seven, we've been talking about this for a few years now, but in 2024, the S&P is up over 20%. What about the 493 other stocks? What were they up? 10%. Okay, now it makes sense. All the growth, 55% of the returns, had to do with 7 stocks. We would never put all of someone's money or equity in 2 stocks or 7 stocks or 10 stocks. We believe in diversification. We believe in asset allocation. We'll talk about that. So the market has been very, very concentrated, and I've got a couple more slides to show you, but it's been very concentrated. Recently, there was a day this year in 2025 where one of these Magnificent Seven companies went down about 20% in literally one day. So that volatility there's a reason we diversify. We wouldn't want that on the other end. Okay, just to really drive this point home, I want to show you the bottom chart here is number of S&P 500 stocks that ended the year down negative 5% or more in 2024. There was 133 companies, 133 out of the 500 that were negative. Say last year was good. We made money, we did good. 133 companies literally lost money. Their stock was down at least 5% last year, 126 the year before. So there are a lot of opportunities in this market. There are some companies that have done very, very well, but there are some that have not done well, and maybe there's some rotation coming. We'll see. Let's talk about valuations. We have to talk about valuations. PE ratio, the forward PE ratio, again, 30-year average. We talk about this every year. About 16.9% right now. Let's call it 17%. So one standard deviation out, one standard deviation out. That's your bell curve. So you go about 20 down to 13.5, and 17 is right in the middle. Currently, the S&P 500 is trading at 21.5 times forward earnings. That is expensive. Obviously, it's expensive. Look at the last time it was that expensive. It was right before 2022. Lo and behold, 2022 stocks go down. They're not overvalued anymore. They're attractive. Start buying, and it pushes it back up. So nowhere near the issues we were having back in the late 90s, the tech bubble, but this is looking very expensive. Well, Dave, why are you not stressed and telling me that the market is overvalued? Thanks for asking, friend. Let me tell you, the top 10 stocks are actually very overvalued to the tune of 29.8, let's call it 30 times earnings. The remaining 490 stocks are trading at 18 times earnings. So let me go back here. The average PE ratio is 17. Almost every stock, 490 of them, is 18. Those are not expensive, but 10 of them are extremely expensive. So of course, you get the weighting of these top 10 stocks up to almost 40%, the highest we've seen, decades and decades and decades. We do think this reverts back to a little more normal here in coming quarters, but time will tell. Volatility. Okay, showed you this for fixed income. Now I'm going to show you this for stocks. Remember, we have at least twice a year on average, the market pulls back. That's a 5% decline. And then once a year, so this is showing the intra-year decline, once a year, the average decline of 14.1%. So despite that decline, we're positive 34 out of the last 45 years. I really like those odds. I'm going to stay in it. I think you should too, as I always share with you. But these red dots represent how far down we've gone at some point during the year. Quite the drawdown, but then we finish higher almost every year. Asset allocation and investment principles. We're going to finish up with some good old principles, starting with your mother called to remind you to diversify. Just had to put that in there. Okay, asset allocation. The old Brinson Hood Biebauer study. This is very famous. 91%, 91.5% of your performance has to do with one factor, asset allocation. That's why we spend all our time there. That's why we always talk about it. That's why we'll never stop talking about it. Security selection, picking the hot stock of the week, market timing, dumb luck. You know, this is the person that likes to brag about the one thing they did good, but they don't tell you about all the times they lost money. You can get lucky once in a while, but really it's all about asset allocation. So we will continue to focus on what we know has the biggest impact on a portfolio. I love this chart. I put it up last year. Really illustrates asset allocation, and not just that, but time in the market and not timing the market. So if you look at the last 20 years, annualized S&P returns, you made 7.5% annualized. There was over 5,000 trading days in the last 20 years. If you missed the best 5 days, your annualized return was cut down to 4.3%. If you missed the best 10 days, you lost more than half, 2.6%, down from 7.5. So I don't even need to, obviously you wipe out your returns by missing the rest of the best days, but it just shows how important it is. Get your money invested, keep it invested, and don't worry about the down days, because remember, the best days that we have are often following the worst days. Think about that. So the worst days are the ones that make you stress. They're followed by the best days. If you miss the best days, you're absolutely cutting your returns, kneecapping your returns, as they say. What about investing at an all-time high? Well, we had 57 all-time highs in 2024. That was 6% of the trading days, but 31% of those all-time highs became the new market floor. So an all-time high is nothing to be afraid of. That can become the new floor that corrections correct down to. And it's hard to see. There's a lot going on in this chart. I'm not going to spend too long, but that's why we always tell people to get invested and not wait. There will be many all-time highs, many different years. And then the range of stocks, bonds in a blended portfolio, this goes back to 1950, so I'm showing you 75 years. If you just looked at a one-year time horizon, yes, stock portfolio could make a lot, it could also lose a lot. The bond portfolio could make a lot, it could lose not quite as much. A blended portfolio, a nice balanced portfolio, is somewhere in the middle. But as soon as you get past that one-year time horizon, let's look at 5-year rolling, 10-year rolling, 20-year rolling. Everything gets concentrated on the positive side of the line, and especially a blended portfolio. You basically can't go negative, essentially, is what the studies show if you stay invested over all these rolling periods. And that goes to show, look, you can do really well, you got to stay in it. And everyone's time horizon is different, but nobody's time horizon is 1 year. Nobody's time horizon is 1 year. If your time horizon is 1 year, you should be in cash. If that money is to go buy a car in 6 months, it shouldn't be invested. And we talk about that during our financial planning sessions. But if you're in your 50s, your 60s, your 70s, your 80s, your time horizon is many, many years, many, many years. My oldest clients in their 90s, their time horizon is not 1 year. The money that their heirs will invest in, they will inherit, even if it was a year later, the time horizon is almost always much longer. So with that, we'll do what we always do, and we'll take questions. Please send me your emails. I love the calls. I love the emails. It's always fun to hear from you, and we'll reach out and connect. Thanks again for making it a great 2024, just a wonderful year, and we're looking forward to this year. Have a great day.